Before we dive in, please review these ground rules. This content is for educational commentary only and is not a recommendation to buy or sell any security. Remember, markets involve substantial risk. In this video, we will cover the island reversal on the QQQ, the significance of the 724 level, the current state of semiconductors, and market rotations. We will also analyze CO1. We begin with the island reversal pattern. While the S&P has reclaimed its gap, the real story, the tell, is found in the NASDAQ. The S&P's recovery has invalidated its bearish island structure, but looking at the S&P alone obscures the real risk. Our focus must remain on the index that failed to pass the test, the NASDAQ 100. Looking at the QQQ, we see a clear setup. A breakdown gap formed an island reversal. Price rallied to the top of that gap, but faced a complete rejection, confirming the pattern. An island reversal occurs when price gaps in one direction, trades for a period, and then gaps back, stranding a cluster of candles. This traps market participants, creating significant supply or demand upon retest. These patterns generally operate on a 3 to 5 day clock to be negated. If price does not reclaim the island within this window, the pattern is usually considered confirmed. To track this, we count the progression, from the initial gap down in base building, through the rally attempt, to the final rejection at the top of the island. By day 5, buyers failed to reclaim the gap. Day 6 saw a complete rejection, reinforcing the bearish outlook. It has been a textbook technical setup. Following the rejection, we saw end-of-quarter moves. The current market is showing significant rotations, which suggests capital is being reallocated rather than exiting entirely. Next, we examine the, quote, 724 problem. This situation involves a put wall below, a declining 22 EMA above, and key retracement levels squeezing price action. Our framework relies on 3 moving averages, the 12 EMA for swing setups, the 22 EMA for market control, and the 55 EMA to monitor institutional support. On the QQQ, volume is currently very low. While the 55 EMA provides some support, the 12 and 22 EMAs are declining, signaling a bearish trend in the shorter timeframes. Finally, we note the put wall at 700. It has been tested multiple times without breaking, acting as a floor for the market. However, we remain cautious until that floor is tested further. Let's look at the 724 level, which remains a key resistance point. It aligns with the declining 22 EMA, effectively acting as a magnet and a rejection point for the market. By anchoring a Fibonacci retracement from the recent move's low to its high, we find 2 critical levels, 717.85 as the 50% midpoint, and 725.53 at the 0.618 level, where rallies frequently fail. This creates a pickle zone between 724 and 725.53. With a put wall at 700 acting as a floor, price is tightly constrained and likely to resolve with significant volatility. While rallies appear to be failing, it is important to distinguish this from true liquidation. We are currently seeing sector rotation as capital moves, rather than a full market exit. Intraday shorts are risky here, due to heavy event risk. With upcoming earnings reports and a loaded calendar of economic events, it is best to keep positions tight. Moving to semiconductors, the bears appear to be in charge. The sector failed to hold its opening print and closed below the 22 EMA on the daily chart. The semiconductor sector's inability to hold its opening print is a classic bearish signal. Since the sector often leads the broader market, this weakness reflects on the overall tape. Semiconductors have now spent 2 days under the 22 EMA, indicating firm bear control. While the 55 EMA remains as potential institutional support, the shorter-term trend is clearly pressured. The SOXX index is forming a concerning head and shoulders pattern. The neckline is the critical level to watch. It serves as a warning until it breaks, at which point it becomes a primary target. On the 4-hour time frame, technical indicators like the RSI have failed to reach oversold territory, signaling a lack of fuel for a meaningful bounce and confirming the underlying weakness. We refer to the lack of a neutral oversold reset without price recovery as quote, sweeping the leg. Institutions use this to lull retail investors back into the market before resuming the downward trend. To understand the market better, we break the session into distinct time windows. The first hour is typically dominated by retail, while the final 90 minutes reveal the true institutional intent. During the retail hour, we often see emotional entries. The middle of the session is usually two-way chop, setting the stage, while the institutional window at the end determines the trend. Using the rectangle technique, comparing the price boxes of the first hour and the final session hour allows you to visualize what both retail and institutions are actually doing with their capital. Today, retail pushed the market to its highs in the first hour, but those levels were never revisited. This lack of follow-through is a classic fingerprint of distribution. Moving on to today's institutional activity. In our second box analysis, it's clear institutions were selling into the close. While they sold throughout the day, the institutional window at the end of the session removed any doubt, as the price finished at the low of the day. Here is a documented look at the 11 a.m. short trade. We waited for the rally to fade before entering. We also sold calls to open, allowing time decay to work in our favor while the chart trended lower, providing a solid cushion throughout the afternoon. Why sell calls alongside the short? It captures more than just direction. It collects on time decay and high volatility premiums. In a bearish structure, this strategy pays even when the market is flat, turning grinding hours into profitable ones. For our toolbox, let's look at RSI settings. We use a length of 15 based on OHLC, not just the close. In fast volatile markets, we often switch to an EMA for faster signal reaction. On today's trade, this helped identify the failed retest, providing a clear trigger. Now let's explore the rotation map. While nobody can predict the future with certainty, after 2 decades in the markets, we look at probabilities. A line chart helps visualize exactly where those capital flows are moving. Using a line chart overlay with your watch list is a powerful technique. By tracking multiple sectors simultaneously, you can see which are strong and which are weak. Don't waste time trying to force a trade on a dipping stock. Follow the money flow instead. Looking at today's overlay board, we see a clear distinction. Large caps, biotech, and software sectors were seeing bids, while semiconductors were under consistent selling pressure throughout the session. This highlights where the institutional capital was focused today. The NASDAQ 100 serves as our primary demarcation line. If a stock is trading above it, it shows relative strength and is a candidate for longs. Below it, relative weakness makes it a candidate for shorts. Today, the split between semiconductors and the rest was clear. Summarizing the flows, we saw rotation into defensive megacaps, biotech, and software. Conversely, we saw clear rotation out of semiconductors and mid-tier subsectors, confirming that institutional preference remained with larger, more stable capital structures. Why was the Magnificent Seven a logical trade? Some of these names are currently cheaper than the broader S&P based on PE ratios. During periods of market fear, capital often hides in the largest, most secure balance sheets, which explains today's defensive bid. However, we must watch for cracks. Microsoft, for example, faces potential free cash flow issues due to aggressive capital expenditure. While the defensive rotation holds, it's a reminder to own the theme while questioning the specific health of its individual components. Single name risk remains high. Headlines regarding leadership changes or specific product narratives can cause massive swings in market cap. This high volatility is exactly why we prefer baskets or sector-based ETFs over picking single ticker winners. Now let's discuss the volatility trap. When the VIX is low, but the average true range of individual names suggests a crisis, there is a discrepancy. Always trust the ATR for a realistic view of how much a stock is actually moving. The ATR, or average true range, is essential for sizing positions. It shows the typical daily travel of a stock. Before entering any trade, check the ATR to understand what normal movement looks like for that asset in the current environment. Consider SanDisk. Its ATR has nearly doubled in a month, despite the stock price remaining at similar levels. This increase in volatility means the stock has twice the potential for movement for the same amount of dollar exposure, requiring adjusted risk management against established structural ceilings. While the VIX at the 15th of May suggests a calm market, it can be misleading. In reality, single-name stocks are moving significantly more than in previous months. The index appears steady only because these components are effectively canceling each other out, a phenomenon tracked by a specific gauge. This leads us to our warning light, the implied correlation index, or CO1. It has reached an exceptionally rare level, historically preceding significant market shifts, such as the yen carry trade instability observed 30 days after similar readings. CO1 measures the volatility of the S&P 500 in relation to its top 50 stocks. When the index is high, stocks move together. When it drops, they decorrelate, leading to a bifurcated market where winners and losers offset each other. Monitoring this helps identify when the market is losing its structural cohesion. A break below 8 in the CO1 index marks a significant concern zone. This is a rare, extreme reading that requires careful historical review. It is not about making predictions, but rather about understanding the probabilities and preparing for potential shifts in the market regime. Extreme decorrelation indicates underlying breadth deterioration that may go unnoticed. We are essentially operating on unstable ground. While the market may correct itself, hitting such extremes signals a potential change in regime that demands immediate attention. Historically, correlation lows like this have preceded major market spikes. These are the moments when complacency regarding single stock risk leaves the market vulnerable to sudden, violent recorrelation during a macro shock. This low correlation state acts as the dry tinder for future volatility. Comparing today's data to the period before August 2024 reveals striking similarities in the correlation index and price action. The sequence of a quiet bifurcated market followed by a sudden yen carry trade unwind and subsequent volatility spike happened in roughly 1 month. When we overlay current market behavior with the pre-August 2024 sequence, the patterns rhyme significantly, including the state of the VIX and the correlation backdrop. When conditions align with past events, the goal is not to predict the future, but to be prepared for the possibility. A counterargument is that prior experiences often teach market participants to hedge, potentially altering future outcomes. However, it is vital to acknowledge that we cannot be certain of how the market will respond. Showing these charts ensures we are prepared, regardless of the outcome. The key item to watch is the dollar-yen trade. It serves as a transmission line between a calm, bifurcated market and a correlated crash. Adding this to your daily watch is crucial, especially if it begins to unwind while the correlation index remains at these extreme lows. This final section covers rotation targets and key events for the week. We will examine where money has been moving and identify the potential tripwires that could impact market performance in the coming days. Analyzing healthcare stocks, we see a distinct difference between retail and institutional behavior. While retail investors were panic selling early in the day, institutions remained calm and eventually provided support for the sector, highlighting the importance of institutional signals. In the consumer staples sector, we observe a similar pattern but with more intense institutional activity. While retail focused on other areas, institutions were quietly positioning defensively. This supports the broader market observation of reducing risk while maintaining exposure. Financials and regional banks are seeing an inflow of capital, indicating this is not a broad exit from the market. Regional banks remain attractive due to their valuation relative to the broader market, and the current interest rate environment serves as a relevant backdrop for these trades. In the industrial sector, we've seen a rally that runs contrary to distribution patterns. Even with those who shorted Caterpillar during this strength, there are no immediate problems in these names, which makes the next topic a critical one to monitor. The follow-through problem is evident today. While GEV hit all-time highs, it rejected the move. Names like CRWD and PANW also failed to hold key levels after tagging new highs, indicating a lack of conviction from buyers at these peaks, with CIBR as a notable exception. Looking at the NDX buy side, we see larger cap names hanging on by their fingernails. The primary danger sequence to watch involves selling that pushes us to lower lows compared to the Thursday print, which could trigger a rapid move to the downside. Tonight, we face a major event, Samsung's preliminary earnings at 8 p.m. While the numbers are expected to be stellar, the real question is how much is already priced in. Since Asia trades ahead of us, any prior bid-up could lead to a, quote, sell the news reaction. Looking ahead, there are two potential resolutions for tonight. Scenario A is the wash, where a sell-off acts as a needed de-risking event. Scenario B is the trap, where an initial bid-up is used to offload shares to retail investors, requiring us to watch for follow-through tomorrow. This week presents several tripwires. Beyond Samsung tonight, we have Fed minutes on Wednesday and Treasury auctions for the 10-year and 30-year notes. Any one of these events could act as a catalyst, and assuming one's ability to predict the outcome is an amateur mistake. The most important confirmation to watch is the lower low relative to Thursday. If that level breaks, we could enter the get-me-out phase. Until that occurs, we remain within a range supported by a put wall, so keep a close eye on the reaction to the Samsung news. Reviewing our key levels, the QQQ .618 retracement sits at 725.53, serving as a rejection rail, while 724 marks a ceiling at the declining 22 EMA. Below us, 717.85 provides balance, with the critical put wall anchored at 700. In summary, the island holds, but semis are under bear control. While money is rotating into defensive areas rather than liquidating, the extreme correlation levels remain a concern. Stay hedged, and watch for the triggers we have identified, rather than assuming the market ground is as solid as it seems. At Hollow Point Trading, we prepare you for these institutional levels before they occur. For more insights, visit our website, follow our YouTube channel, read our Substack, or explore our interview-only Discord, which is open for enrollment this week before closing until September.